exposing the secret sauce in business-to-business marketing. The Tagline Podcast is where real stories meet proven strategies. Let's elevate your business. Real strategies, real stories, real results. In the business-to-business industry, you're not selling to businesses. It's human to human. We break down what works, what doesn't, and how you can truly stand out. Transparency, credibility, growth. Get a behind-the-scenes look at what drives success in business-to-business marketing. Get ready for the next Tagline Podcast powered by the Ably Group.
Welcome back to the Tagline Podcast. My name is Justin Starbird, and I get to welcome, a good friend. It's new to me, and we're doing a lot of stuff together. It's Jonny Price, president of Wefunder. Jonny, so great to have you on today.
Thanks, Justin. Good to be here, man.
I think this is long overdue. I feel like we've been, in communication a lot. But we never really have done a deep dive into what makes all this tick. And I'm so excited to hear, a little bit more about you, about WeFunder, and the industry in general. So I'm really excited for today's discussion.
Love it, man. Me too. Better late than never.
Yeah. Okay. Johnny, what does the president of WeFunder do?
Good question. I mean, honestly, I just talk to founders all day long. Which I love. I think I have the best job in the world. So obviously, I'm also kind of running the business development team at WeFunder. But yeah, my day to day, a lot of it is just talking to founders who are considering launching a fundraiser on WeFunder, whether that be a Reg D or a Reg CF, and then kind of helping them to succeed on the platform, guiding them on the strategy, how to set it up right, and how to just kind of raise as much as possible and have it just go as well as possible. So I've been doing it for 8 years now. Joined WeFunder back in 2018. So it's been so cool to see the evolution of the product and, our company and the whole industry that we kind of our founders pioneered back in 2012 when they worked on getting the Jobs Act through Congress. But yeah, it's been a really fun ride and looking forward to the roller coaster continuing over the next 8 years.
Yeah, you mentioned the roller coaster. You couldn't be more accurate with that. Talk a little bit about the mission and what made, taking this role, even that, 6, 8 years ago, taking that role and really owning it to shepherd WeFunder through, some of the changes in legislation and how it's now a little bit more mainstream.
Yeah, so the original genesis of WeFunder back in 2012 stemmed from the fact that our founders, who were serial entrepreneurs, Nick Tomarello, Greg Belote, Mike Norman, and they wanted to invest in their friends' startups, but because they were not accredited, they weren't able to. And so they said, this isn't very fair, and it's not very American, that you have to be a millionaire to invest in startups. Retail investors can invest in public companies, but not private companies. So that was kind of the origin of where WeFunder came from. And so along with other people, they helped to get the Jobs Act through Congress in 2012, signed into law by President Obama. And that basically paved the way for unaccredited investors, the vast majority of the population, to invest in pre-IPO private companies before they went public. And there were kind of two halves of the WeFunder mission, right? We're a two-sided marketplace. We help founders raise capital and we enable investors to invest in startups. And so from a mission perspective, on the founder side, the idea is, if we can enable more people to participate as investors in startups, we can get more capital flowing to startups. And maybe also we can get more capital flowing to different sorts of startups, where, and not just tech startups, but it could also be mainstream businesses. Like
Yeah.
maybe if kind of people, who live in a certain neighborhood or community can invest in a restaurant that's opening up in that community, then we'll have more independent local restaurants starting up. Maybe like healthcare. I know we collaborate on a lot of healthcare deals. Healthcare is interestingly our number one sector on WeFunder. If you have people that have been maybe affected by cancer, either themselves personally or a friend or family member who get to invest and vote with their dollars, maybe we can get more oncology startups capital that they need to take it to the next level and explore whether their kind of potential approach to, curing this particular cancer might have some legs. And maybe then you can kind of get more capital flowing to these kind of founders than the conventional, VC or conventional kind of, investing market might allow. So that's kind of the founder side of the mission. If you unlock kind of retail investor dollars going into private companies, we can get more capital flowing to founders. And then on the investor side, the idea is just, why should only rich people get to invest in startups? It would be cool if anyone got to invest in, the next kind of AI startup that would be more equitable. I give this example where it's kind of tragic for me that with all the wealth that's being created with these AI companies, obviously a lot of that wealth is going to be created in the public markets, right? So those
Yeah.
investments are more kind of open to everyone to participate in. But a company like Anthropic or OpenAI, I mean, I don't know what valuation they're going to be out if they ever go public. I mean, I guess SpaceX is now maybe finally going public at around $1 trillion, but that's like $1 trillion of wealth that's been created where, the 90% of the population that isn't accredited doesn't get to participate in.
Yeah.
And so if AI is going to create vast wealth, but a lot of that wealth is going to be created from private companies before they IPO. And if all of that wealth creation is limited to accredited investors, I think that's kind of a bit of an economic tragedy, honestly. And it's not just me and, Team WeFunder that says this. Like I heard the founder of Robinhood, Vlad, talk about this on stage at All In. I heard, yeah, I know this is a top priority for the new SEC chair. More kind of retail investor participation in private markets. So a lot of people are kind of focused on this problem. And yeah, that was the kind of investor side of WeFunder's mission. And I think pretty motivating to me and all of us that work at WeFunder.
Yeah, I couldn't agree more. The idea of the IPO being at $1 trillion or more, all the money has been made at that point, and these
Or maybe
very
not all. I think if Anthropic IPOs at $1 trillion, I don't know what they'll go out at. I'm sure there's a lot of upside after that as well, to be fair. But yeah, exactly. It's like I always give the example if in Uber's seed round, if you'd had like 1,000 drivers invest, then you could have had like 1,000 drivers becoming millionaires at the IPO. That would have been really cool. And so yeah, sounds like we're on the same page there, which is unsurprising.
Yeah, no, I couldn't agree more with you there. And it's again, it's a newer vehicle to be able to do that and give access to folks that wouldn't have it otherwise or wouldn't even know where to start, right? I mean, I think that so you talk about the tragedy, right? The tragedy is that there are so many people that don't have control over their actual investments, whether those are via the 401k or they're investing in a fund and somebody else is making those decisions. So you don't have a chance to spread that around. With WeFunder and other, crowdfunding platforms, you do, and I feel like that is the real opportunity. And I mean, candidly speaking, it's still in its infancy.
Yeah, very much so. I mean, it's grown a lot since when I joined in 2018. The law changed in 2016 to allow for regulation crowdfunding. But yeah, it's still very, very early days, I feel like.
Yeah,
There's still a lot of kind of potential for us to grow into on the Reg CF side. And obviously, as you know, Refund is now also supporting more and more Regulation D raises, where it's okay, these are focused on accredited investors, companies that just want to, focus their raise on accredited investors. WeFunder can support that too. So now, whether you're doing a more conventional Reg D raise or you're doing a Reg CF raise and opening up what we call a community round, we can support you on both. But yeah, on the investment crowdfunding side, the community round side that we call it, totally agree. Very, very early innings.
From your vantage point where you're leading fundraising in these community rounds on WeFunder, describe what you see as the current state of crowdfunding right now. What's actually happening underneath the headlines?
Yeah, so I would highlight maybe two things. I think one on the kind of market trends and two on the maybe you might call it like a bifurcation of the industry. So on the kind of macro trends, the industry overall, I mean, it was rolled out in 2016 by the SEC. It was a bit of a fanfare at the beginning. The rules initially, as written, were not very good in the sense that like you could only raise $1 million per year, and if you had 1,000 investors, it would screw up your cap table. You can roll them up to one line on the cap table using an SPV. And it would also take several weeks to even start fundraising. In 2021, the SEC made a number of changes to significantly improve the Reg CF rules. So the first one, they increased the cap from 1 million to 5 million. So per year, you can raise 5 million. Secondly, they allowed for SPVs, special purpose vehicles, to roll up the 1,000 investors in your WeFunder round to one line on your company's cap table, which is an absolute like game changer, kind of black and white, like was previously didn't work, now does work for a lot of good companies that have options. And then thirdly, they allow for what's called testing the waters, where you can start fundraising immediately. You don't have to first get the legal paperwork done with the SEC. You can start fundraising and testing the waters, gauge investor demand, and then kind of get the legal paperwork done in parallel. So those three improvements in March 2021 were awesome. That coincided with the kind of COVID stimulus checks, like kind of tech bubble of that year, right? And so for WeFunder as a whole, WeFunder is the largest Reg CF platform. We have been every year since 2016, and we are again this year. And so generally, the kind of WeFunder growth is going to mirror pretty closely the market, the industry growth. And so WeFunder tripled in 2021 by investment volume. And that was, 8 years into the company's journey. So it wasn't on a zero base, right? We already had some traction and then we tripled again. It was very exciting times. And then in 2022, the market turned, right? Kind of tech stocks crashed. If you remember, like alternative investing kind of bubble burst a little bit, crypto bubble burst, like the NFTs. I saw some stat that I think OpenSea's NFT transaction volume dropped by like 96 and 97% or something crazy like that.
Yeah.
And so we found it wasn't anywhere near that, severely affected, but certainly you saw a decline in 2022. As with a lot of kind of, alternative investing.
Sure.
Since then, we've started to get kind of growth going again. It's definitely not, tripling every year. Sadly, maybe we can get back there. But now growth kind of starting to come back. And for me, part of the reason for the kind of underlying growth, it was facilitated by those rule changes from March 2021. But a lot of it also is around kind of prestige and signal. And so when I started in 2018, there were not many kind of super legit venture-backed companies that were doing Reg CF, maybe occasionally, but it was pretty rare. With the rule changes from 2021, you have more and more companies that are very credible, like some of the best companies in the world that are very desirable to VCs. A good example is Mercury Bank. They raised 120 million Series B, led by Co2. Andreessen Horowitz invested in that round. And then they opened up a $5 million community round to let their customers invest. And they oversubscribed that. They raised $5 million in 24 hours. And their customers just, went crazy. And it's like, wow, we get to invest on the same terms as Andreessen Horowitz here. This is so cool. Like
Yeah.
that for me is like the beautiful kind of, picture of what a community round could and should be about. And they recently, I think it was last year, announced, or may have been earlier this year, they announced a Series C led by Sequoia. So that's also a question sometimes is like, oh, if you do a community round, does it make it harder to raise follow-on financing? Well, obviously Sequoia is a pretty good data point to say if it's good enough for Sequoia, we're probably fine here.
Yeah.
Replit's another great example. They did an 80 million Series B. I think it was 2022 from memory. And then $5 million community round. Their founder, Amjad Masad, said the reason he did it was exactly what you and me were talking about earlier, which was his phrase was, we wanted to let our community share in the upside,
Yep.
share in the wealth that obviously they're a lovable competitor, kind of, really leaning into kind of AI coding. And they also just raised a big Series D a couple of months back. So great on paper kind of win for the thousands of community members who
Yep.
invested in the community around a couple of years back. Substack, Beehive, Levels, these are some of the other examples I'm talking about. So I think one of the reason that we're seeing the growth in the industry overall is that we're kind of still crossing the chasm where this is still, as you said earlier, there's a lot of founders that just don't know about this, or there's a lot of questions about like, is this going to mess up my cap table? It used to, not anymore. Is this going to make it harder for me to raise follow-on financing from VCs in the next round? Well, because of the SPV, actually, no. See, Sequoia led Series C for Mercury and many others, we're starting to see some exits. Beta Bionics was one of the first companies to raise $1 million on Wefunder in 2016 when the RegCF rules went live. Last year, they went public in an IPO that was like close to $1 billion. So
Yeah.
we're starting to see some companies that now have gone through the full journey or are kind of, going through the gears and follow on, VC-led financing rounds. So that's, I would always want the growth of the sector to be faster. But the underlying trend, I think, is positive and we're on the right side of it. So that's kind of the first point around the like overall kind of market trajectory. The second point is the bifurcation that I mentioned. I think this will resonate with you. I kind of see two approaches to the industry here. One, and to illustrate the spectrum, the extremes of the spectrum, the end we want to be at WeFunder is the Mercury end, where okay, they have a huge customer base that loves the product, like absolutely rave about the product, and they're raising a Series B led by some of the best VCs in the world, and their community is invited to participate in the round as a small allocation, 5 million of 120 million, on the same terms as Andreessen Horowitz, and they oversubscribe it in 24 hours. That is the dream, right? It's like there's
Yep.
organic investor demand. That company has earned the kind of explosive community round and interest from investors and who are getting to invest on the same terms as VCs. The other extreme is a company that, is raising on insane valuation that's like through the roof, like doesn't make any sense. No serious investor would ever do it. It's a common stock investment versus a preferred stock investment. No serious angel or VC would ever do common stock. And they're spending like $2 million on ads to raise $5 million. We don't want to do that. We funder. But for me, there's kind of a bit of a bifurcation going on in the industry where that's kind of one approach. And then, we want to be a little bit more focused on kind of organic or earned community rounds versus kind of heavily ad driven, like heavily kind of spammy marketing stuff. And so, yeah, sometimes I feel like we're kind of tarred with that brush, which can be frustrating. But yeah, that's certainly a trend that I kind of see in the industry, and it's honestly a little concerning to me.
Yeah.
And
And me
sometimes
too. I mean,
yeah,
that end of the spectrum is really difficult because, at the end of the day, you're the sum of what you've put out there.
mm,
And we see, unfortunately, we've seen some of that in the space because similarly, we get painted with a similar brush
mm,
from the agency perspective in that, the only way to raise is to
right,
ads out there. And we approach it from a different angle and try to. And then when the need comes or when the opportunity, we look at it as an opportunity to layer in ads or paid opportunities because it then amplifies the organic elements that we've done, which, in our opinion, makes everything more authentic. And we leave our clients with assets that they're able to then use after the raise is over, because the way it should, in my opinion, dovetail together is that, the raise only helps, make the process for, selling that product, or getting subscriptions for, or however they're going to make money. It only lends itself to be able to do a better job of business development. So I feel,
Totally agree.
yeah,
Totally agree. I think that's one of the reasons we love working with you, right? You're helping founders tell their story and produce content and generate kind of, earned media. We like that word, earned, or organic. And obviously, again, those were two extremes of the spectrum, right? Like every company is somewhere on that spectrum, somewhere in the middle. And it's not like WeFund is morally opposed to founders, running ads to raise money via RegCF. Especially for me, if there's like Olympian Motors is a company that's live on WeFunder right now. They make electric cars. And I don't know what their kind of, LTV is or their price point is, but it's obviously tens of thousands of dollars. Like if they're spending ads to recruit an investor, and then that investor is like pretty likely of becoming a customer, then all of a sudden you have kind of two birds with one, ad spend stone, right? You have, okay, this ad spend is driving investment volume into the raise, but it's also driving potential revenue and customer acquisition.
right.
And so now it's like, oh, yeah, like let's go hard.
Yeah.
So definitely not kind of morally opposed to the ad spend, but yeah, I think one of the reasons we love you and the team at Tag is, you are kind of very aligned with us in kind of saying, hey, if we're just relying on ads here, it's just kind of not, that's not
Right.
kind of how we want to approach this whole kind of industry.
Yeah. I want to go back because there's a lot to unpack in the trends and what you're seeing from your vantage point there. And you mentioned the misnomer really around VCs not uh, valuing a community round. And I want to dig into that a little bit, because that is something that we often run into with founders and their
Mm.
hesitation with community rounds. And that is that they're not going to get, or get VC or private equity, or uh, investments from high net worth individuals or accredited investors. And what we see, and it'd be interesting to have you, validated or come at it from another angle, is that a lot of those offices use the community rounds as validation test points or litmus tests to say they have a community of people that are interested in this, and now they feel more comfortable putting money into this deal because they had done a great job with their valuation, or they chose an SPV that made sense for that deal. What do you see from the VC side, or from the investment side beyond the actual community?
Yeah, I think it's pretty complex and nuanced. At the end of the day, I think a kind of rational, like intelligent venture capitalist, and I think Sequoia has a good, reputation. Um, you know, they're going to invest in a company that they think is going to make them tons of money, right?
Yeah.
Maybe in the olden days, like before the 2021 rule change, like 5 years ago, when WeFunder would put 1,000 people on your cap table, maybe there might be some people that was kind of a negative, kind of signal for, or a negative kind of thing. So that might have made it harder to raise follow-on financing. But with an SPV, that's how a lot of companies are raising via SPVs, right? And rolling up kind of investors, whether it's Reg D or Reg CF to one line on the cap table, and then there's one signatory who signs for the SPV. It's a very kind of tried and tested approach to the cap table and rolling up investors to keep governance simple. So I feel like that kind of knocks that concern on the head. And so then it's just like, okay, is this company growing like a weed? Is the TAM huge? Is the founder and the team amazing? Like, is this going to make me and my LPs tons of money? Okay. Like, and I just, whether there was, a bunch of accredited angels in the SPV from the last round, or whether it was a RegCF SPV on WeFunder, or whether it was, some other VC, like I feel like is pretty secondary. And also everything is a signal, right? So if you had Andreessen Horowitz lead your last round, like that's really awesome, right? And if they're kind of continuing again in the next round, then yeah, like it's probably going to make it easier for you to raise money, right? Probably like, the extent to which like having a $5 million community round as an SPV on your cap table, does that kind of, nudge you like a little more kind of up or down on the kind of myriad of things that a VC would consider? It probably depends on the company, right? I think if you're consumer facing, especially, but and interestingly, right, like medical device companies and biotech companies are having a lot of success on WeFunder, and they're actually saying that they're seeing value in having thousands of people as investors in them as well. So it's definitely not limited to consumer facing companies. But for me, especially for B2C companies, if you have thousands of your customers who are like owners and investors in your company,
Yeah.
I don't really know how you could argue that that wouldn't be a net positive.
Right.
And we've seen good data, multiple studies, including our own data. We've raised 20 million ourselves at WeFunder on our own platform from 8,000 investors. And if you look at the investing activity of those 8,000 people who've invested in us versus the 400,000 investors on the platform who haven't invested in us, then the 8,000 investors in WeFunder are super active, like sending us deals, sending us like people that we might hire for positions and just responding to any asks that we put out for them. And so yeah, that's very much our pitch is that to any founder, especially a founder who is B2C, especially a founder who cares about building community, if you invite that community, those consumers, customers to invest, then that can have very, very positive impacts on your business, makes you more resilient, lower churn, higher LTV. This is kind of there are data-driven studies that have looked at public companies and find, okay, investors in public companies spend more money with the companies they invest in. And obviously the ownership of a public company is like much, much smaller
Yeah.
than the ownership of a private company, where, you kind of loom a little bit larger because the valuations are still earlier. So yeah, we're obviously aligned, but that's kind of my pitch to any founder. This is this can really benefit you and your company in a bunch of ways. And these are potentially thousands of people that, if you make asks of them, they're often very, very happy to help. We had a good example. This company GeoShip came on our podcast, and founder Misha said that he had $100 investor in his community round on WeFunder who connected him to $1 million investor. So, can be customers, can be hiring, can be product feedback, and in that case, can be, investor intros as well. Really cool example of that.
I love that. One of our mutual colleagues, Hiten Sunpal, the CEO of Rise Robotics, Rise did $5 million on the platform last year. We've been fortunate enough to work with them as well in partnership with others like Capital Department. But one of the things that he said was that one of the unintended benefits of the community round was that now he has the largest sales force in all of the state of
Right.
Massachusetts because
Exactly.
he,
Yeah.
you know, he it basically gives them direction and says, "Hey, we're looking for this. Can you
Right.
help us?"
100%.
Yeah,
Yeah. And I think that's cultivated by the fact that they do a great job with kind of updating their investors and continuing to build that community, right? In large part, thanks to their partnership with you guys and the work that you do at Tag. But yeah, for me, the best community rounds are ones where the founder is building the relationship with that
yeah,
community of investors, not just during the raise, but then afterwards. You're posting, maybe quarterly investor updates. Those updates have asked, or, okay, this is how you can help. And those investors, they feel like part of the team. And they're kind of proud to be associated with this. It's cool. Startups are cool. People don't normally get to participate as investors in startups. Um, and so, yeah, love that example from Rise of the sales team. I'm going to
yeah.
use it.
And one of the things they gave out was a plaque to say thank you. So people actually got like, it's like getting a watch for your 10-year anniversary. But,
Yeah.
what on the other side, not to make it negative, but on the other side, not everybody gets to 5 million. Not everybody gets beyond the 1.235 million to go
Mm.
to the next level. In your opinion, what are, and not all of them have goals to reach that. So that's to be clear as well. Like not everybody wants to have a community around that oversubscribes to 5 million in 24 hours. Sometimes they only need a few 100,000 to get to the next step. But that so they consider that a success. But for the ones that maybe aren't as successful as they initially had hoped, or
Yeah.
what tends to be the biggest difference between the ones that have been really successful and the ones that have not met their goals?
Yeah, so as with all good former management consultants, I have a three-part framework to answer this question. Ready to hand. The first would be, is it a good investment? So, like you can't, if you don't have a company that people want to invest in, you're going to struggle, right? And so one of the things that I spend, I feel like a lot of time on calls, maybe with more junior kind of founders, trying to counsel them on is like, are you sure this is the right time to raise money? And if you're like really gonna have to push and like you don't really have a growth rate or you don't really have a product or you don't really have kind of the things that investors are going to be looking for. And so you're just going to be out there pushing, 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 and like no one's gonna invest. Obviously, then that's gonna make it a lot harder, right?
Yeah.
And so we actually released a product recently at Wefunder that is exactly geared towards founders in this situation. It's called Warm Up. Um, I really like it. The idea is basically it's kind of building on principles in a book about fundraising called Fundraising, I think, by Ryan Breslow, the founder of Bolt. And the principle in this book was basically, okay, as a founder, if you're fundraising, like don't just like start and cold pitch people, like reach out to those people, build a relationship with them, put them on an investor email list, give them updates on how the company is doing and kind of build their interest so that then when you do pitch them on investing, you've warmed them up, hence the name warm up. Um, and so for me, you know, if you don't yet have investors lined up, don't start a fundraise, right? Do a warm up, set up a page on WeFunder, kind of like a social media account, but for a company that's looking at, one day maybe raising money, post updates, build that audience of investors, build up kind of pent up investor demand so that then when you do launch a fundraise, they're warm and they're almost kind of pulling the fundraise out of you versus you trying to stuff it down their throats. So that's kind of like, the is it a good investment? And obviously part of that is, the valuation terms, the investment structure. Um, so that's the first thing. The second thing is, the audience. So obviously when Replit or Substack does Wefunder, they have millions of users that love the product. So that's boom, one email, $5 million in 24 hours, right? When, if you're an early stage biotech company, you probably don't have a million customers, right?
Yeah.
So you don't have that kind of audience of customers or users. So then it's like, okay, what's the founder's network look like? And so you gave the example of Hit and Rise. Connor Cullinane is the founder of Pirouette, YC company backed by Safar, who last year did 7.7 million on WeFunder through a combination of Reg CF and Reg D. This year they just closed another 5 million. But for Connor, he again pre-FDA approval didn't have a huge network of users, but he had his LinkedIn network, right? And he's a YC founder. He had the YC kind of network and he just worked it. So you don't need a huge audience of customers or community users, but obviously that helps if you do. So the audience, like size of the audience, like honestly affluence of the audience, right? If your customers are kind of low income, they're obviously gonna invest at a lower rate than if your customers are kind of, rich upper middle class people. And then the other factor of the audience is like how much do they love the product?
Yeah.
or love the brand, love the mission, company, love you as a founder, right? If your net promoter score is through the roof, then if you go to those customers and say, hey, want to invest in us, they'll all jump at the chance.
Yeah.
I feel like sometimes CPG companies like maybe don't do quite as well on WeFunder as they might think. And with CPG companies, let's say a food and beverage CPG company, you know, it's it's maybe rare that you love a product so much. And even if you do, you buy it like, every few weeks maybe in a grocery store.
Yeah.
Whereas like Mercury, they're a bank. Like, okay, their customers are using them like every day. The product looms a lot larger in the customer's life.
Yeah.
And so, then when you say to that customer, hey, want to invest in us, it's much more front and center. And then the third thing, and this kind of goes back to what Connor from Pirouette did, is just like the founder's ability to execute and say, okay, so you've got a company people want to invest in, you've got an audience, at least to get going. Now, are you going to execute? A big part of that is like, how much time are you going to invest in this?
Yeah.
So
That, yeah.
some,
I was
some
gonna,
founders will try to do like 2 hours per week, right? And then some founders will say, this is my full-time job. Obviously, if you're working like 20x the hours or 30x, if you probably work like a typical founder, you're just going to raise so much more money more quickly. And not just like the number of hours, but also like how you are spending those hours, right? Are you doing it on kind of high ROI activities?
yeah.
And then also, are you working with Justin and the team at Tag, right? To, make sure that the content you're putting out there is like really high quality and you're kind of avoiding the rookie mistakes from a strategy perspective. And are you willing to spend dollars and deploy resources to, work with experts to help you kind of nail the execution? So yeah, that's my framework. Typically long-winded framework. You're trying to interrupt me there, man. I'm like, no,
Yeah,
nothing
well,
derail my
you're right
framework.
though. So far, again, we're newer to this. We're 18 months into being a part of your community, and we're helping to do right by you by also helping these founders to be successful. And immediately, one of the biggest differences that we see is it's the amount of time and the amount of time they're spending on the high return on investment opportunities, and looking at those, those funnels and those investments, and how can they have somebody double down or reach that next level via a perk, or do something where there's an
Mm,
enticement. Generally
right.
speaking, we've been on more the B2B sort of raises, which inherently, I think, to your point, are a little bit more challenging unless you have a great story and a really
Mm,
great team, and somebody that's willing to execute or delegate the right, have the right partner. I feel like we're a really good partner where we are able to adapt to your team and amplify the abilities of the core team that you have, so that the team is working on the best return on investment of their time, and
mm.
not doing all the little minutia. And so, people, our companies have used us in a couple of different ways, but generally speaking, driving strategy and campaigns, but then filling in the gaps where their teams are. But the biggest difference that we see is the amount of time, effort, and energy that the founders are willing to put into it and take responsibility for those things to happen.
Yeah, totally. I think it's like the first of those things, is it a good investment, is kind of the product that you're working with, right?
Yeah.
Um, and part of that, I think, is like the campaign page, the profile page. I think you could argue that the profile page is the product. You could also argue that that's kind of the distribution. But yeah, maybe the third thing of like the founder execution, that would be like the distribution. And there is always that debate, right? Like, is it if you build it, they will come, or is distribution important? And like, I do think to a large extent on WeFunder, like that if you build it, they will come. There is some element of truth in that, where if you have if Elon Musk was to launch a WeFunder tomorrow, right, for his like new startup, then he would fund $5 million immediately, right, without needing to do anything, right? He puts out a tweet, boom. Elon, if you're listening, we're here for it. But so you can't like Pirouette, they brought in 83% of the dollars from WeFunder's investor base, which is really high. Normally it's less than that. But I guess that's a good example of what I mean here. Generally, we see a pretty good correlation between like what I would judge as like a good investment, right? Like maybe they have VCs who are investing on the same terms, they're growing really quickly, whatever, great team. Those companies tend to pull in more from the WeFunder investor base. And then companies where it's like, I don't know if a VC or a conventional investor would really want to do this, then they tend to pull in less from the WeFunder investor base. It's not rocket science, but
Right.
I guess so to that extent, I do think there's some element to which, the product is very, very important, obviously. But then, as we've been saying, the more you can hustle, the more you can like put yourself out there, the more investors you can pitch, the more, marketing content you can do. Obviously, as with all, kind of go to market and kind of marketing, the more eyeballs you can see on the product, the more, customers, or in this case, investors you're going to get. So it's a bit of both, right? The product is super important, and then also the distribution. And as with all marketing, the more compelling the product, like the higher the return that you'll get on those marketing activities and on the distribution you're doing.
Yeah. I want to go back to one thing. Oh, we got a couple more minutes, and that is to talk a little bit. You mentioned warm up. WeFunder as a platform has undergone some significant changes in the last 6 months to improve user experience, to improve investor experience, to improve founder experience. Of course, there's been, a little bit of, some hiccups here and there, some bugs and things to work out. Yeah, I think you're in a great space now for all of those. Talk a little bit about some of those changes and what your hope and intents were or are.
Yeah, so many changes. It's honestly been the most exciting time in the 8 years I've been at WeFunder. Obviously, very much fueled by these kind of, AI-based approaches to coding. I'm not a software engineer. I never wrote a line of code in my life, but in the last few months, I'm starting to, be able to fix bugs for users or, push features like, and I try to say pretty self-contained, right? You don't really want me touching too many user-facing features, but an admin kind of management reporting dashboard that, previously we would have wrestled with a business insights tool to pull together and, paid a monthly subscription to a SaaS company. And now I can just build it myself in a few hours. And it's like exactly perspective. This is amazing. And so we've really leaned hard into that. And the pace of like product velocity at WeFunder is an order of magnitude higher. Obviously, this is not any new news, right? We're a tech company. We're using AI to help us code better. Wow, But yeah, just in terms of like the things that it's enabling us to do, to your question, are very exciting. And obviously, we're moving quick, so yeah, there's some kind of friction, teething problems. We're working through those. Generally, our approach on WeFunder is like we move fast and we more quickly get to the right answer by moving fast. But yeah, some of the examples, say the warm-up product I mentioned, say enabling founders to basically build an audience, build a following before fundraising, so that then when they do launch the fundraise, they can get more of a bang immediately out the gate, which I think just makes a ton of sense.
Yeah.
We also mentioned earlier we're supporting Reg D SPVs as well as Reg CF SPVs, and I think we might be the only platform that kind of enables founders to like kind of move between the two. So maybe you're going to launch a community round kind of publicly, but you kind of run a Reg D SPV privately initially to close on checks from accredited investors in your network, kind of build up momentum before you kind of publicly launch. So then you can get your hands on the funds a lot more quickly and it'd probably be a little bit cheaper. So I think that's like huge. And obviously there's a lot of companies that don't want to do Reg CF. They don't want to publicly share financials, which is required by Reg CF. So then for those companies, now they can use WeFunder to run a Reg D. And the other kind of big one, and so many kind of product changes which you've probably, experienced and are benefiting from, is around kind of social investing, you might say. So we now have a feed, like Facebook's innovation, right, was the news feed. And so we have that for users where they can see, yeah, okay, investors that I'm following, any investments that they made, or investor notes into companies that I invested in, or updates from founders that they invested in. So the feed is an example of that. The ability to follow other investors is a big part of that. We have spotlights now, which are kind of TikTok style videos
Yeah.
where founders can tell their story, and we've given that quite a bit of exposure on the Explore page, very much in line with that spirit of, WeFunder wanting to be about kind of organic and investors, right, and telling founders stories. So those are a few examples, and like the directory page is another example, right, where now as a founder, let's say you have thousands of investors, you can filter and see, okay, which of those are accredited, or you know, which I can sort them in descending order of what the AI thinks will be most relevant to my business, or I can filter by investors that said they could make intros to other investors, which is usually about 10% of investors on WeFunder
Yeah.
say I can make intros to other investors, or maybe there's a filter for like give product feedback or make intros to customers. And so those are four examples, many others of how WeFund is just trying to really lean into the community and community rounds and say, as we were talking about earlier, right? Like if you raise 5 million from thousands of people, how can we build tools and just like orientate the whole ethos of WeFunder to be, okay, if you have thousands of people invest in your company through WeFunder, that's actually meaningful. And
Yeah.
like they're benefiting from that as investors. They're kind of getting a front row seat. They're kind of seeing, content and like being part of the journey. But then you as a founder are also benefiting from a myriad of ways that they can like help you in the company. So yeah, that's the kind of social investing kind of features that is the other kind of third big kind of pillar of some of the bigger product features that we've rolled out over the last few months.
It's all been really exciting to see, and so thankful that we've had a front row seat to that. So I'll get you out of here on this. I have listened to you on other shows and talk about, your hidden superpower, and you've described it as relentless positive energy. How how do you take that and help founders? What are you most looking forward to over the next, 6 to 12 months?
Yeah, I mean, I do think that's my biggest superpower. I think I've some good strengths and a lot of very big weaknesses. I'm glad you asked me about my strength and my weakness. Appreciate that. But yeah, I mean, I just think with who I'm always looking to bring onto my team, right? I would say the biggest thing for me is positivity.
Yeah.
It's like if you're a positive person, I'm gonna enjoy working with you. If you're a negative, startups are hard, right?
Yeah.
Even like Anthropic on right now, probably the most insane like historic run of like revenue growth. But they have problems. I'm sure it's chaos over there. It's 2,500 people. I heard that when Google passed the same revenue milestone, I think it's 30 billion ARR maybe. Google was like, I think 125,000 people and they're 2,500 people. So
Yeah.
I'm sure it's like a reorg every 10 minutes. And, like everyone is just like going crazy. And so that's hardship of a different sort, right? Sometimes it's like 2022, the market crashes and investment volume's down and you have to lay people off. That's a hardship. But then even in Anthropic, there's a hardship of a different dimension, like it's just chaos. So generally with startups, like it's going to be hard. And so,
And
you're
there
going to
is no
have
good time. Like right now, we're
right.
in the midst of, our own crazy economic, what we don't even know what it is. We're only 6 or 8 weeks into this, and it's just
Yeah.
insane. So
100%. It's not
there's
just
never a good.
startups, right? It's life. Life's
Yeah.
hard. So if you're going to be cynical and negative along the journey, you're going to be less fun to be around.
Yeah, we have a
Uh,
strict no asshole policy. It's
yeah. Yeah. No asshole and no kind of cynical negative
yeah,
people. But yeah, and next 6 to 12 months, honestly, just like continuing the growth. I'm excited to be supporting founders on Reg D SPVs. That's a benefit for a lot of founders that don't
yeah,
want to do a Form C filing and do a Reg CF, and then continuing the growth of Reg CF, continuing the like product innovation, more features around the social investing that I mentioned. So yeah, it's a really exciting time. I feel like the AI coding is just kind of really accelerating kind of the innovation. And yeah, it's great to be working with you and the team at Tag on supporting a lot of founders who are running community rounds on WeFunder and excited to, let their customers and community invest potentially alongside, VCs and angels.
Yeah. Well, I appreciate all the kind words, and I appreciate you taking the time to join me today and talk through all this. This has been really wonderful, Johnny. I appreciate it.
You got it, man. This was fun.
On behalf of my guest today, Jonny Price, the president of Wefunder, you've been listening to the latest episode of the Tagline Podcast. Until next time.